We're all familiar with the term recession, but what if I told you that what's coming is worse? It's not just a downturn. It's a perfect storm fueled by unprecedented debt, rising inflation, and a market that's dangerously overpriced. Here's a shocking fact: global debt has hit a record $300 trillion, more than 3 times the size of the entire global economy. That's right. The entire financial system is sitting on a ticking time bomb. And it's not just a matter of if it will explode, but when. Charlie Munger, the legendary investor and Warren Buffett's right-hand man, has been warning about this for years. While most people are focused on today's headlines, Munger has his eyes on the bigger picture. He knows that the risks hiding beneath the surface could be far more devastating than a simple recession. In this video, we'll break down the shocking truth about what's really happening in the economy. We'll uncover why inflation and debt are silent killers, how the cheap stocks everyone's chasing could be traps, and what you can do now to protect your investments before the storm hits. Stay tuned, because the next few chapters will give you the inside track on surviving, and even thriving, when everything starts to unravel. You won't want to miss this. Chapter 1. The calm before the storm. Why the market is a ticking time bomb. When most people think of market crashes, they picture sharp, sudden drops. But Charlie Munger, Warren Buffett's longtime partner, warns that the worst economic upheavals often sneak up quietly. Markets may seem calm now, but under the surface, they're full of red flags. One of the most glaring issues is the sheer amount of debt across the globe. According to the Institute of International Finance, global debt has skyrocketed to $300 trillion. That's more than 350% of global GDP. This debt is a ticking time bomb. In times of crisis, countries and companies struggle to pay back their debts, which can send shockwaves through the economy. Another silent threat is the overvaluation of assets. Take the stock market, for example. The Shiller P/E ratio, which measures the price of stocks against long-term earnings, has recently hit levels last seen during the dot-com bubble of 2000. This suggests that stock prices are disconnected from real value. When reality sets in, prices will have to adjust. Munger himself has spoken about the dangers of irrational exuberance. He often reminds investors that optimism can distort our judgment. Right now, the economy is fueled by an overconfidence that hides the risks beneath. This optimism can drive prices higher, even when the fundamentals are weak. Then there's inflation. The latest numbers from the U.S. Bureau of Labor Statistics show that inflation has risen sharply, with the Consumer Price Index, CPI, increasing by over 6% in recent months. High inflation erodes purchasing power and adds to the strain on businesses and consumers alike. When people's wages aren't rising fast enough to match inflation, the pressure on the economy intensifies. But here's the real kicker: monetary policy. The Federal Reserve's decision to keep interest rates low for years after the 2008 financial crisis has created a bubble in many asset classes. When interest rates eventually rise, borrowing becomes more expensive, and asset prices may begin to fall. This could trigger a broader market collapse. Many investors ignore these risks, focusing only on the positive market sentiment. But as Munger warns, markets that look like they're soaring can often crash the hardest. It's crucial to pay attention to the warning signs now before it's too late. Chapter 2. Charlie Munger's Final Forecast. A legacy of caution. Charlie Munger's investment philosophy has always been one of caution. He's never been a fan of speculation or taking unnecessary risks. Instead, Munger advocates for a long-term approach based on finding companies with solid fundamentals at a fair price. His most famous quote is, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." In other words, Munger believes in limiting risk and making thoughtful, calculated decisions. In recent years, Munger has repeatedly warned that the current market is overvalued. He's compared the current situation to a bubble, saying that it's hard to see how we get out of this without a serious problem. His warning isn't just about stock market crashes, it's about the entire economic system being overleveraged and vulnerable to shocks. One of Munger's key strategies is to stick to what you know. He often advises investors to focus on businesses with strong brands, dependable management, and a competitive edge. Invest in what you understand, Munger says, echoing Buffett's famous advice. This is especially important during times of uncertainty when the market can be unpredictable. A perfect example of this strategy can be found in Munger's partnership with Buffett. Over the years, they've invested in companies like Coca-Cola and American Express, which have proven resilient despite economic downturns. These companies aren't just profitable, they have deep moats or competitive advantages that protect them from competitors. Munger also advocates for a margin of safety, a concept made famous by Benjamin Graham. This means buying companies at a price below their intrinsic value, providing a cushion if things don't go as planned. In today's market, finding stocks with a margin of safety has become more challenging, but it's not impossible. Ultimately, Munger's message is clear. Be prepared for the worst, but focus on quality. Don't chase the latest market trend. Instead, invest in solid businesses that will endure through tough times. Chapter 3. Hidden Dangers. How inflation and debt are the real threats. When most people think of financial risk, they think of stock market crashes or recessions. But Munger believes the real dangers lie in inflation and debt, two factors that often get overlooked by many investors. Inflation, the rise in the prices of goods and services, has been creeping up for years. According to data from the U.S. Bureau of Labor Statistics, inflation rates have exceeded 6% in recent months. While this may seem like a manageable number, inflation at this level can erode the value of your money quickly. For example, if you had $1,000 in savings a year ago, it would only have the purchasing power of about $940 today. For businesses, inflation means higher costs for materials, labor, and other inputs. When these costs rise, companies often pass them on to consumers, which can lead to a decrease in consumer spending. As consumer confidence drops, so does the overall economic activity. But inflation isn't the only threat. Debt levels worldwide are at unprecedented levels. In 2023, global debt reached a staggering $300 trillion, according to the Institute of International Finance. This debt is not just limited to governments. Companies and individuals are also heavily leveraged, making the entire financial system fragile. When interest rates rise, as they likely will, this debt becomes more expensive to service, which could trigger defaults and bankruptcies. Munger has repeatedly warned that an over-leveraged system is unsustainable. He argues that when debt levels get too high, it creates a moral hazard, where people and institutions take on excessive risk because they believe they won't be held accountable. This is one of the key reasons why financial crises often start with high levels of debt. One of Munger's favorite pieces of advice is to avoid borrowing money for investments. He has said, "The best thing you can do is stay within your circle of competence and never borrow money to make investments. When you borrow to invest, you're essentially taking on the risk of losing more than you invested if things go wrong." In today's environment, debt is a huge risk. Munger's approach would be to avoid taking on excessive leverage and focus on investing in businesses that have low debt levels and strong cash flows. When markets get tight, companies with too much debt are at risk of failing, and you don't want to be caught holding those stocks when they do. To survive in this environment, Munger's strategy is clear. Keep an eye on inflation, stay away from excessive debt, and focus on companies with solid financials that can weather any storm. If you follow this advice, you'll be much better positioned when the inevitable storm hits. Chapter 4. The Great Value Trap. Why cheap stocks might be a dangerous mirage in times of economic uncertainty. Many investors flock to cheap stocks, hoping to find bargains that will pay off in the long run. But this strategy, while tempting, can be more dangerous than it seems. The reality is that not all undervalued stocks are good investments. As Charlie Munger has often said, price is what you pay, value is what you get. Just because a stock is cheap doesn't mean it's worth buying. One of the key mistakes that investors make is buying stocks based solely on their low price. This is a dangerous trap. A stock might look cheap, but it could be cheap for a reason: poor fundamentals, shrinking market share, or a failing business model. For example, look at companies in declining industries, like traditional retail, where e-commerce giants like Amazon dominate. Many of these companies may appear undervalued on paper, but their long-term prospects are bleak. Munger warns investors to look for value, not just low prices. He advises, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. This is an essential lesson in value investing. Rather than focusing on short-term price movements, it's critical to evaluate the long-term strength and stability of a business. In fact, studies have shown that buying companies with strong fundamentals, consistent earnings, low debt, and a competitive advantage tends to lead to better returns over time. According to data from the CFA Institute, companies with a solid balance sheet and consistent revenue growth have historically outperformed the market, even during recessions. Another aspect of the value trap is the market's reaction to negative news. When a company faces bad news, such as a leadership change or regulatory issues, its stock price can drop sharply. While some might see this as an opportunity to buy at a discount, Munger advises caution. Often, these bargains are reflecting deeper issues that won't easily be resolved. Investors must ask themselves, does the company have a sustainable business model? Does it have a strong moat, a competitive advantage that protects it from competitors? Companies with weak moats are far more vulnerable in times of economic downturn. And when the market eventually realizes this, those cheap stocks can quickly turn into costly mistakes. One way to avoid the value trap is by sticking to what you know. Munger's investment strategy is all about focusing on industries and companies where you have a clear understanding of how they work. If you don't fully understand the business, don't invest in it. This strategy minimizes the risk of being deceived by misleadingly cheap prices. Chapter 5. Survival Strategies. How to prepare your portfolio for the unseen crisis when economic crises strike. The best thing investors can do is to be prepared. As Munger often says, the best thing a human being can do is to help another human being know more. For investors, this means educating themselves about the risks in the market and building a resilient portfolio that can weather the storm. One of the key strategies Munger recommends is diversification. While he's not a fan of over-diversifying, he does believe in spreading investments across different asset classes and sectors to reduce risk. A well-balanced portfolio includes stocks, bonds, real estate, and even alternative investments. By not putting all your eggs in one basket, you increase your chances of staying profitable when one asset class takes a hit. But diversification alone isn't enough. Investors need to focus on quality, not quantity. Munger advocates for a concentrated portfolio of businesses you truly understand. He suggests buying a few great companies, rather than dozens of mediocre ones. This allows you to put your money in companies with strong fundamentals, steady cash flow, and a solid management team. Cash reserves are another essential part of Munger's strategy. Having liquid assets available can help you take advantage of opportunities during market downturns. When the market falls, some of the best companies can be bought at bargain prices. But this is only possible if you have cash on hand to make those purchases. Additionally, Munger advises investors to remain patient. This may sound simple, but in practice, it's one of the hardest strategies to follow. In times of uncertainty, fear often leads to rash decisions, such as panic selling or chasing after speculative stocks. Munger teaches that the key to successful investing is staying calm and sticking to your long-term strategy. As you build your portfolio, consider adding defensive stocks, those that tend to do well even during economic downturns. For example, companies in the healthcare, consumer staples, and utility sectors often perform better during recessions. These businesses provide essential goods and services that people need regardless of the economic climate. Munger's investment philosophy emphasizes patience, long-term thinking, and avoiding short-term distractions. By focusing on companies with strong fundamentals, keeping a cash cushion, and staying diversified, you can better navigate the next crisis when it comes. Chapter 6. The Long-Term Play. Finding opportunities in chaos. While many investors panic during times of crisis, the seasoned value investor knows that crises present opportunities. Charlie Munger has often said, the stock market is a device for transferring money from the impatient to the patient. Those who are able to stay calm and think long-term often come out ahead when the dust settles. The key to taking advantage of a crisis is to focus on long-term value, not short-term market movements. Munger's strategy of buying when others are fearful has been a hallmark of his success. During market downturns, many investors sell off their positions in a panic, which drives prices down. For those with the stomach to wait, this creates the perfect buying opportunity. It's important to remember that markets eventually recover. The average bear market lasts about 9 months, while the average bull market lasts more than 4 years. If you're invested in high-quality companies, a market crash can actually be a gift. For example, when the 2008 financial crisis hit, many investors sold off their stocks in fear. But those who held on to strong businesses like Coca-Cola and Apple saw their investments recover and grow significantly over the following years. Munger also advises investors to focus on companies with strong management. If you want to know whether a company is a good investment, look at the people running it, he says. Great leaders can guide companies through tough times and come out stronger on the other side. In contrast, poor management can lead a company to ruin, regardless of how good its product or service is. Another opportunity during crises is to invest in industries that are positioned for long-term growth. Technology, healthcare, and green energy are sectors that have shown resilience and promise for the future. Even in times of market turmoil, these sectors continue to evolve and expand. Finally, Munger teaches that patience is crucial. In a world that increasingly demands instant gratification, value investors must take a different approach. They must be willing to wait for opportunities to come to them, even if it takes years. This long-term mindset is often the difference between success and failure in the world of investing. By focusing on value, avoiding short-term distractions, and staying patient, investors can not only survive a financial crisis, they can thrive in it. As Munger wisely states, the big money is not in the buying or the selling, but in the waiting. Don't forget to subscribe. If you found these strategies valuable and want to stay updated with more expert tips on value investing, don't forget to subscribe to our channel. You won't want to miss the next video, where we dive even deeper into the next wave of economic shifts and how to protect your financial future.